Now, another thing I just want to cover and tell you, having a consistent playbook, backtesting your trade setups, importance of trading one setup to perfection. So, for example, if you read our book, you'll see that we broke down these different patterns, different markets, many things, okay? Now, these days I only trade one pattern and one pattern only. That doesn't mean I don't know about these triangles, I don't know about other patterns, head and shoulder, for example. I know many people like head and shoulder. They read it in the book, it looks so nice, and they start trading it. For example, let me show you. There's a head and shoulder on gold. The thing about head and shoulders, why I don't trade them, it's hard to get a head and shoulder because they don't come to perfection, okay? Now look at this. I'm sure some of you got it. This is a head and shoulder, okay? Look, markets came up, that's a left shoulder, this is the head, and this is the right shoulder. So that's what people like calling it. I find this pattern to be quite, to me it's quite silly. To me, markets are just moving as A, B, C. This was just markets moved to the downside, respected the support level. Let me draw for you, let me show you. Where are my tools? This was the support level, okay? Which now many people will call the neck. And then now you have up here the sort of this level, the left shoulder. Market came and for me, at the simple, these are just key levels. Market just broke below, retested this key level, moved to the downside. But people term it as head and shoulder. You know, we normally give ourselves meaning. The mind doesn't like things void. It always gives meanings to things that even don't make sense. You can create patterns in your head where there are no patterns. You call that patternicity or apophenia. You can do research on that. It's just psychological stuff. But anyway, it's just funny. Now, look at this pattern here. Now, what I was saying that time frames can discount patterns or candlesticks. Look at this. This is a head and shoulder, okay? On the 1 hour chart. Open the 4 hour chart. Look at that. It's not a head and shoulder here. Here it's just market closed here, move to the downside, okay? So it just depends on the time frame you're looking at, okay? So, what was my point? I think I went overboard there. Okay, trading one pattern, okay? So for me, I trade one pattern and I focused on it. And why is it important to do that? Because in the end, you want to create a playbook, okay? And I tell my students this, you want to create a playbook of how you're going to be trading. And a playbook is created by trading one pattern to perfection. Once you understand how it works, the ins and outs, you go to the next pattern. When you start out trading, it's normal for you to trade everything. You can trade the triangle, you're trading the flags, you're trading head and shoulder. So you're just trading everything. But at the end of the day, it's not the best way to go, okay? You need to trade one thing and trade one thing to perfection, okay? So it's important. You need to perfect on one thing. It's just like swimming. You perfect on one stroke. You can know all the strokes at the same time, but you keep doing this freestyle over and over again until you get it to perfection. Then you move to the butterfly, then you do the backstroke, then you do the breast, okay? So it's better to do that because let's say you're thrown into the ocean. You had just started learning, but you wanted to learn all styles. So now you start swimming freestyle, then you start kicking backstroke, then you start kicking butterfly. My friend, you're going to drown.
Yeah, hell yeah, I can swim, girl.
You okay?
Huh?
You okay? Stand up. Wait, stand. Give me a floaty.
I can't hear.
Grab the floaty.
Grab my hand.
Grab the floaty. This motherfucking nigga. See this?
You can't do all that at once. Get one. Now compare that to someone else who started swimming the same time with you. Wasn't really looking to know how to swim all the styles, but really focused on swimming this one style to perfection. You'll just see this guy swimming across the ocean, just going to safety, okay? So that's the same thing with trading. It's a different mindset that is hard to get to people because still, you'll come like here, you'll get this triangle, okay? What makes you think I won't trade this triangle? It's discipline. At the end of the day, it's discipline. I've gone through the market so many times just trading any pattern I see, and the market has beat me over and over again until I learned, okay, I need to trade one thing and one thing only, okay? So that's just something I wanted you guys to know. Have a consistent playbook. Trade one pattern and understand it. I think my students understand this, and that's why we have different groups, okay? There's the school where I'm trading my pattern with my students. There's another school for Ken. There's another for Taras. And even us as the mentors, we stick to our own. You'll never find me telling my students, I'm trading Taras's pattern today. My patterns have not been working. No. One setup and one setup only, okay? And that's how you build your trading playbook. Okay, once you understand one pattern, move to the next one, because it entails a lot. It entails what are the candlesticks patterns that are good for this pattern? What are the psychological journeys that people can go through in a certain pattern? Okay, it's a lot. There's a lot entailed in it, but in a nutshell, that's what it is. Now, one last thing, a bonus thing that important plays in the market: successful follow-throughs and failed follow-throughs. Okay, now this is basically just another term for breakouts and false breakouts, successful breakouts and false breakouts, but I like to call them successful follow-throughs and failed follow-through. It might sound complicated, but it's really not. It's very simple. So normally what happens, for example, like this one, if you go to the 1 hour chart, like what we are covering, this is what I call a failed follow-through. So what's a failed follow-through? So this is important when you're looking at trend lines, key levels, and such stuff, okay? So for example, look at this. Market came and respected this level and moved to the upside. Now remember, this is another key level. It was a broken. It was back here, okay? So market didn't just come and turn around there. It was a key level. Market came, moved to the upside, came back down a second time, bounced above, came down a third time, bounced above, okay? And then when it was coming a fourth time, it sort of had this wick, okay? And then came and broke below, okay? Now this breaking below, what you normally want to see when market has broken below a key level or above a key level is a successful follow through. What does that mean? You want to see the market continuing in the direction that the market has broken, okay? Now sometimes you'll get this what you call a failed follow through. What is a failed follow through? Market broke below and immediately came back above, okay? So that was a trap. That was a clear stop hunt or a trap for many sellers, because that was liquidity, and that's why market is a lot of momentum to the upside. Many people sold there at this bottom, and right now they're wondering, why is the market going up? I thought we just broke and this is a very significant level. No. You want to look for a successful follow through, okay? Let's look here previously. Look at this. This was a key level. Look, you want to look for such break above, a significant break, okay? Not just a small break, a significant break. Look what happened immediately, a successful follow through, okay? And markets shot all the way up. What happened here? If you short here, I'm not saying it's a bad shot, because it was a good signal. It was a good signal that market has broken below. But immediately this happens, cut your losses short. Cut them. Come out of that trade very fast. Look what happened. Market is just moving to the upside, okay? Sometimes you normally get something of the sort. Market can come, break through, and then in its successful follow through, come back up just to retest here. Not close back above. Okay, market can come back above and retest here before it goes down, but closing above, now that's what we call a failed follow through. And now if you come to the bigger time frame, it's not even a failed follow through. This is a pin bar, okay, or a hammer, depending on how you call it. This is a very bearish signal that market is going to go up, okay? But when market breaks above a significant level like this, you want to see it continuing moving to the upside, okay? Now that's a successful follow through. Look at this one, a key level. This is on the 4 hour chart. Look, market significantly broke above. If you look at this week, market came back, retested that level, then we had a successful follow through. We came and had a retest of that level, and market stayed above. If market closed below this level, that's another significant red flag. Come out of those bulls, okay? That's what I'm telling you. Trading is quite simple if you can follow the basic things the market is telling you, and you'll be wrong. If you sold here, you'll be wrong. You'll be wrong. Market moved up, and it's okay to be wrong. It's not like it's the end of the world. Why was I wrong? It's wrong. Markets moved to the upside. I was wrong on that trade. I accept it. I'll close my charts for today. We recoup tomorrow. Okay. So that's basically it. So that's what I wanted to cover. Those are follow throughs. I think I'll do deeper videos on that. I see I've taken already 1 hour. I think I want to answer some of the questions. But I hope that has been helpful, just to understand charts. And basically, how do you understand charts? Spend the time. There's no shortcut. I may teach you a thing or two, but there's no shortcut on that one. Let me show you a candlestick pattern that I really love, that whenever you see that candlestick, you do not want to negate the market. This one, okay? You see this one here? You see this one? Leave this one here. This one here, this is a very significant bullish pattern. And it's normally formed as market is moving in the direction of the trend, okay? It can form also on the downside, but it forms towards katikati, it's somewhere on the road, okay? What it normally means, if you understand candlesticks, is that market sort of, during this time frame, market was sort of moving to the downside. But towards the end of the market session, during that time frame, okay, it closed significantly higher than the level the low level it went to, that's a significant buy signal. Okay, now remember, there are candlestick patterns and the chart patterns. Now there are candlestick patterns which are many and are quite good, and the candlestick patterns are what creates the charts patterns. Okay, so if you don't understand significant chart patterns like this one's shooting star, doji, amarubozu, such these tweezer bottoms over here, or spinning tops, spinning bottoms, it's important to understand those before you move into even understanding about significant chart patterns. Okay, so I hope I've been of help.